Good morning, ladies and gentlemen. Welcome to our annual results presentation. To start this presentation, let's have a look at the picture in front of us. This is one of our service technicians in South Korea installing a hypercompressor a few weeks ago. And this compressor will generate spare parts and maintenance during about 50 years. And today, we have more than 20 other such hypercompressors in the systems division, either in the production phase or in the installation phase. So this will really lift up our service revenues in the coming years. This is what we call our integrated business model. Today, Rolf and I will give you an update about our fiscal year 24 and outlook in our fiscal year 25, of course in the context of trade tariffs, but also in the context of midterm megatrends that support our business. Assuming that everyone has read the disclaimer on page 2, I will jump to page 5. In summary, we delivered a record year 2024, despite the further normalization of our market in the systems division and the weakening of the European and the Chinese economies. This demonstrates the strength of our model with a global footprint, a large range of applications, and a resilient service business. Now going to the different highlights. We delivered a record number of compressors, and with this, we reached sales of clearly above 1 billion. That was, since a long time, our star. One day will be 1 billion. We reached that 1 billion, almost 1.1 billion. And we also reached, for the first time, net income above 100 million and a record operating cash flow above 200 million. And with this, and the strong balance sheet that we have, it puts the board in the position to propose a dividend increase of 16% to 18 francs. We also did clear progress on our mid-range plan, and we launched new products and services. For instance, I mentioned it in the first half year, we launched compressors for low-pressure LNG tankers, or a sub-segment of it, and we also launched new digital services, which I will present later on. We also made a big step forward towards our net zero ambition 2035, with a very large reduction of our greenhouse gas emissions. So overall, it was really an eventful but also successful year, and we had solid progress towards our mid-range plan. Now, going forward, we have a strong backlog, and we have, of course, challenges coming with the US tariffs, but also megatrends that support the business. And again, I will present them later on. So now moving more precisely in the financials. They show a further progress in our top line, our bottom line, and value creation for the 6th year in a row. But before we get into the detail, I would like to mention one change in our accounting policy for the systems division, which became necessary because we had more and more very large projects in this division in the past few years. So starting in fiscal year 2024, we are applying a percentage of completion method for all projects above 7 million Swiss francs, which lasts more than 1 year. And with this, it reflects better the activity of the year, and it should provide more stability in our revenue recognition in the future. And the fiscal year 2023 has been restated with POC accounting so that you can see a like-for-like comparison. So full details are in our annual report, and Rolf will say more about that later on. So with this in mind, let's have a look at the key financials. So despite a normalizing market, we delivered our second highest order intake, above 1.1 billion, up 2.4% versus the prior year, and above our sales level. So we continue to increase our backlog. And this growth is mostly linked to marine applications and to hyper orders linked to solar panels. I'll come back to that. Record compressors deliveries in the systems division and also a further growth on the services division enabled us to reach 12.6% growth of sales in Swiss franc and almost 14% in local currencies. Further improvements in EBIT margin in both divisions led to a 1.2 percentage point improvement in the group margin to 12.9%, despite the diluting effect of the increased share of the systems division in the overall sales mix. This enabled us to deliver an EBIT of 140.8 million, And for the first time in the history, net income above 100 million, with 105.6 million, up 25% versus the prior year, which is restated. We also had a very strong cash flow with almost 213 million, which led to a positive financial position of almost 70 million at the end of the year. With this increased profitability, but also with the increase of asset productivity, which we will see later on, value creation also went up, with a RONA of almost 33%, clearly up compared to last year. And also clearly above our guidance for the mid-range plan, which is 25% plus. So combined with a strong balance sheet, this figure brings the board in a position to offer this 18 francs, which is a 58% payout ratio, fully in line with our policy of 50 to 70%, and also at the same level as last year. Moving to the next slide, we see how our continuous improvement of top line and bottom line adds up over 6 years. The top line has been growing 10 to 11% per year in these 6 years. Actually, in local currencies, it's rather 12 to 13%. With a leverage of the structure, with also efficiency increase, we could do that with only 6% per year FTE increase. And this, plus the leverage of the SG&A and margin improvement in both divisions, led to an EBIT increase per year of 21% in the 6 years, and even 25% for earnings per share. So we did that in the context of COVID, Russian sanctions, supply chain disruptions. So this shows how resilient our model is, and it also shows something about the culture, about the performance culture of the company. The markets are moving a lot every year, but we are every year focusing on the pockets that are growing, and we're also building some flexibility in our supply chain and in our operations so that we can react to such unforeseen events, just like we have now with US tariffs. Let's now go into the systems market. Overall, after the peak that we had in 2022, it started to normalize in 23, and it went further down in 24 overall. And here I will focus my comments on the first 3 segments, which account for the bulk of our order intake, starting with the petrochemical segment. Here, the demand for hypercompressors in EVA production for solar panels remain strong, especially in China, driven by geopolitics and also the continued expected increase of solar panel growth in the coming years. We sold 7 hypercompressors during the year, including 1 in Saudi, compared to 8 in the previous year, which was a record. And here, the pipeline is still healthy, but as we said last year, in the midterm, we expect that it goes down to 4 or 5 per year in the coming years. The rest of the petrochemical market, so the low-pressure petrochemical market, continued at a good pace. It is basically supported by the middle-class growth in Asia, which requires more polymers, for instance. And that means that also drives the demand for hyper and the Laby compressors. In this market, we have to say, we mentioned it before, we continue to see the push for localization in China. And this is for us a certain headwind. We have our local facility there to capture this, but this is a certain headwind. Now moving to the gas transportation and storage segment, which was the strongest during the year. Very lively thanks to these different marine applications, and I will go into them one after one. Starting with the demand for LNG tankers, which went up again after the dip that we had in 2023. And this is supported by the expected very strong increase of LNG export terminals, which are coming online in the next 2 to 3 years, especially in the US and in Qatar. And for these tankers, the increased or the new renewed interest for the high-pressure LNG tankers, which you know is important for us because this is where we have the highest market share, actually has been confirmed in the second part of the year. I mentioned it at the half-year call that there was the change from one of the engine manufacturer that has focused on high pressure, and now we have all the yards talking to us, understanding the high pressure technology, and potentially some orders in the coming 12 months or 18 months. Now moving to LNG-fueled ships, like container ships, etc. They remain at a good level. The main reason I see is that with all the additional LNG export capacity, LNG prices went down, so it's more and more economical to use LNG as a fuel, on top of the advantages that it has compared to heavy fuel in terms of CO2 emissions. LPG tanker applications, the next one, which for us is very important, hit a new record. So what we saw in the first half year has continued in the second half year, even if not exactly at the same level. And it is driven by the demand for energy growing globally and the need to transport energy from producing locations to transportation locations. We saw also, as I mentioned, the half year, the increase for ammonia tankers. And the driver here is the expectations by ship owners that in the future, ammonia, or especially green ammonia, will be used as a fuel in the marine industry or as a way to transport hydrogen from green hydrogen from Middle East, for instance, to Europe. So all in all, a very lively marine markets, and basically we expect that this market will continue to be very lively in the coming years, driven by energy trade and by sustainable fuel regulations in the marine industry. Now moving to the third one, hydrogen for mobility and energy. Different story. It has clearly recalibrated after the growth that we had in the past 4 years. Reasons are various. One is that the green hydrogen costs are clearly higher than people expected when they did their business plans a couple of years ago. Also because there are delays in the finalization of regulations and subsidies, especially in Europe, and of course, uncertainty created by elections. In the US, of course, Inflation Reduction Act has been really slowed down, but also in Europe, all the elections of last year were not helpful because it has slowed down everything. So that's the short term. Now, if I think about it in the midterm, hydrogen or green hydrogen still has an important role to play in the energy transition as a green molecule. I talked last time about the difference between storing energy in a battery and in a molecule. Molecule can store a lot more energies than batteries. And for some applications, batteries just don't work. You can't do that with electricity. So in the midterm, we see a regained interest for large-scale projects. And actually in our pipeline, we see that we have less projects, but the ones remaining, they are much more concrete. And we expect that the market will come back again, driven by pipeline injections, underground storage, and production of hydrogen derivatives, like green ammonia or e-fuels, e-sustainable aviation fuels, etc. Now, in the next few slides, I will highlight a few achievements of the fiscal year, starting with a tremendous increase of our production capacity in Korea. As you know, operational excellence is one of our pillars in the strategy. And if you look at the past few years, we have been able to absorb this 10-11% per year growth of sales, basically within the same factory walls. And this is exactly what we've done now in the BC Korea. BC Korea is our main facility to deliver these compressors for LNG tankers with high pressure. You see some of them on the picture. And in 2024, they have been delivering the orders that we won in the peak of 2022. So 2 years later, we had to deliver all these compressors, and that's what they have done. And to reach the capacity required and to meet orders from the customers, we had to increase capacity by 40%. So we've changed completely the layout of the factory, changed the logistics, applied lean principle further, and with that, we reach these 24 compressors per year in terms of capacity, and that also will enable us to absorb the potential next peak if it comes in the coming years. Also, in the same facility, we actually will be able to add one more bay in the same premises, so we have more capacity if necessary with small additional cost. Now moving to the second achievement, which you will recognize, I'm sure. This is the rollout of BC Activate, which we announced last year. In fiscal year 2024, BC Activate was used to analyze more than 100 compressors in 19 countries globally. And what is really that's twice as much as last year. And what's also very interesting, almost 3/4 of them were OBC compressors, so non-Burkhardt compressors. So for us, it's a door into the machines of our competitors to do service. And what BC Activate does with a number of special tools, like you see on the picture, it provides a diagnostic of how to improve reliability, energy consumption, CO2 emissions for the complete fleet of our customers. And you see here as well some potential increase of savings that we have identified for energy consumption and CO2 emissions. And with this, we provide recommendations for the customers and offers for the customers to improve the situation. And when they do these improvements, that creates service business for us. You see a few of these examples, like 2 hyper upgrades and boosters upgrades in Brazil and Thailand, maintenance and spare parts for Labi that was generated through BC Activate in Singapore and Uzbekistan, for instance. So very good start. Now we're already preparing the next step, the level 2 of BC Activate, where we use now our digital capabilities, which I will show in a minute, to understand the most complicated cases. So we have a portable digital analytical tools that we bring at the customer, analyze the compressors, and with this we can understand the most complicated cases, and we start to make our customers familiar with these new digital solutions. And this is the topic of the next highlight. In November last year, I introduced you to our first new digital service, Up Insight, which enables real-time monitoring of compressors through our own data acquisition equipment and our cloud solution. Today, I'd like to introduce you to UpDetect. This is the next level digital solution. It is using the same cloud platform as Up Insight, but it can be installed on many more compressors because it has its own data acquisition unit. Also, it has one level more of intelligence. Beyond the monitoring of compressors that Up Insight is doing, it can identify potential failures before they happen, thanks to artificial intelligence. And it provides some automatic message to the customer highlighting the need for service. And with this, our customers can minimize the risk of downtime. And for me, really interesting, this new service combines artificial intelligence, which everyone can do. I mean, Google can do artificial intelligence on compressors, but it combines that with something which is unique that we have. First, as OEM, we really understand what happens in the compressor, so we can help the model to learn much faster due to our knowledge as OEM. And the second thing is the basis that we have with Prognost. Since 15 years, we have this company Prognost, which is doing basically monitoring of compressors. So we have a customer base, we have some hardware, so we can start much quicker in terms of addressing customers and upgrading their Prognost equipment with this new software. And usually our markets are quite conservative, but after we launched this UpDetect in March, we had very strong interest from customers, and we have sold a few of these services. Now, going forward, we expect that these services will become more and more important because they help customers reduce their maintenance cost, improve reliability, and for us, they increase the loyalty with the customer, and they can also generate service. We can telling customers, you have to do a service very soon, then typically they will pick up the phone and call us rather than somebody else because we have already understood what can happen. The last example that I have here showcases how our new digital strategy works out. Previously, we had Prognost as a completely separate entity within Burkhardt. We even didn't talk to told customers that it was the same. Now, since 18 months, we have integrated Prognost into our digital teams and sales teams. And with that, we can create unique selling propositions and sales synergies. Here, in this case, a customer in Saudi wanted to monitor a compressor which was built by GSW, the Japanese OEM. And in the past, Prognost would have offered their hardware and software. You see the picture on the left of what Prognost offers. And they would have potentially won this project, which would have been a $200,000 project. Now comes Burkhardt into the picture. You probably remember that we acquired the GSW compressor drawings and IP 4 years ago. With that, we are the best to understand what really happens in that compressor. Also, during the fiscal year 2024, we have opened a new service center in Saudi, which enables us to offer the installation, the commissioning, and then we can provide local support to the customer. With that, we created a unique selling proposition and we won the project. And if you compare to the business case before, this project was 10 times higher than what we would have won with Prognostone only. It was a $2 million project, basically. So here we see how we create synergies in our solutions by combining Prognos with the rest of the organization. This closes the first part of the highlights. And now I'd like to step back a bit and look at our progress on the mid-range plan during the fiscal year 2024. You know this slide, we present it every time, and we presented it first at the Capital Market Day in 2022. It presents our 4 strategic pillars, and we have made progress across all the pillars during the year. We have basically around 20 strategic initiatives which are behind these bullet points, and we closed some of them during the year. We launched new ones. You see here with the gray area the progress that we have made during the year. And I will highlight a few of them. First, we strengthened our core business in China, also in the solar market with these 7 hypercompressors that we have sold. Also in the marine market with these new solutions developed for the low-pressure LNG tankers. On the service side, our growth on the marine segment has continued and further increased our position in the segment, especially with dry dock capabilities that we have further improved. Operational excellence was also in our focus. You've heard before about BC Korea, and we've done that in other factories. I also mentioned the half-year call, the new project Fit for Growth that we have in Switzerland to do basically something similar in a Swiss factory to absorb the growth within the factory walls so that we don't have to build a new factory in Europe in the coming years to absorb the expected growth. You will also see on Rolf's presentation the leverage of the SG&A and how it improved our EBIT margin. Then moving to the next box, the launch of the 2 new digital services, UpInsight and UpDetect, clearly contribute to building new growth avenues. And moving down the business foundations, here we continued with the rollout of our service ERP. We also fully on track with our sustainability, as you will see in a couple of slides. And finally, on the people side, I would like to mention the amazing 94% participation rate of our employees to the employee engagement survey, and also the results of this engagement score has further increased compared to last year, and that shows us that we are on the right track with the transformation. Focusing now on the systems division, you have again the 4 pillars on the left, the initiatives from the Capital Markets Day, and then the progress that we have made in the division in 2024. I will highlight here also a few topics. First, in the first pillar, I'd like to highlight the increased coverage in certain regions where we see more potential. Middle East, there is clearly a lot of activity. Europe, with the energy transition, and even the US, let it be with old energies or new energies. On the operational excellence pillar, I mentioned already Fit for Growth. Also, we've continued to work on value engineering, which I had as a deep dive last year, and we continue to increase the supports that we get out of our support center in India, where we have now more than 200 engineers and administrative people supporting the rest of the world. Finally, about building new growth avenues, we have started to increase the sales force or to build the sales force in regions where we see new potential. Australia is one of them, South America is another one. Turning now to the services division, we also made significant progress on the strategy implementation. For instance, customer satisfaction, we received this year 1,300 responses for customers, that's more than last year, and still with a very high level of satisfaction. In terms of developments, I mentioned the new service center in Saudi already, but we also created a new legal entity in Abu Dhabi, which is important to offer local content to customers there. On the operational side, I already mentioned the half year that we have closed 3 service centers which were not performing in the US. And we have also further localized spare parts production in China, and we bought a new land in India, where we are currently building a new global production center for spare parts. To build new growth avenues, I already mentioned the digital services and BC Activate, which were the main drive during the year. So in summary, both divisions are progressing well, and we are on track to realize the strategy. And I'll come back to it later on. In the new context of US tariffs, the conclusion is the strategy remains the same, is still valid. We just have to accelerate some of these aspects, especially operational excellence. I'll come back to that later on. Now, let me update you on sustainability. You know, these are our 8 material topics, the KPIs, the targets that we have set for 2027. And here, basically, we are on track to reach all KPIs. I would like to highlight 3 of them. First, on climate, we were able to reduce our greenhouse gas emission intensity without the foundry. That's why we have 38% here versus the 40% in the press release, by 38% within 1 year. And with that, we are fully on track to reach the minus 50% in 2027. The main lever to achieve this first KPI is the second KPI, renewable electricity. Here we've made already a huge progress from the 23% renewable electricity which we had in 2021 to 71% today. So we're very close to the target of 75%. And we realized this by finalizing solar panel projects in Switzerland, in Korea, and in China. We have a big factory roof to take the sun, and also by buying more renewable electricity on the market. Finally, health and safety, one of our priorities. I mentioned that last time that we continue to work on our global standards for health and safety. And despite the increased load in the factories, we managed to reduce the accident rate to 0.4, which is clearly online with our targets, which is a maximum of 0.7 for every year until 2027. So overall, good progress here, good progress in the mid-range plan. And now I would like to hand over to Rolf Brandley, who will tell us more about the financials.
Thank you, Fabrice, and welcome to our annual results conference also from my side. Before starting with the financials, let me make a brief introductory remark. And as already mentioned by Fabrice, we have implemented a change in accounting policy in 2024. Why did we do that? Fabrice already indicated it. We have grown a lot, our business has grown, and with that also the number of large projects that take a long time. So we wanted to have a better allocated value creation process along these projects and also more stability in revenue recognition per se. So we decided, we set the threshold, projects above 7 million in value, and with a duration of more than 12 months will be accounted for under the percentage of completion method. The rest is still under the so-called completed contract method. So with this change, we had to also perform a restatement on the 2023 numbers, and that resulted in a lower sales by 9 million and on a net income level by 5.6 million. So whenever we compare with prior year figures, you will find along this presentation a footnote which mentions this POC change. And again, it's just the systems division that is affected by that. Now, having said that, let's now take a look at the general overview of our results. The strong order intake and sales was already commented by Fabrice, and I will show you in a minute how this breaks down into the divisions. At group level, gross profit increased by 20.1%, yielding a gross margin of 28%. That's 1.8 percentage points above the last year, mainly due to a more favorable product mix in both divisions, the higher capacity utilization in all manufacturing and assembly facilities, and the reduction of unprofitable service business in the US. Fabrice indicated its selling, marketing, and general administrative expenses. They represented 11.9% of sales. That's a further leverage of 40 basis points compared to the prior year, and this shows the further operational leverage on SGA overall, which is in line with our mid-range plan. Research and development expenses increased by 12.8% to 30 million, which accounts for 2.7% of sales. That's well within our target bandwidth of 2.5% to 3% of sales. The higher spending was mainly focusing on strengthening our position in the marine and hydrogen markets with new compressor solutions. Other operating income was negative in fiscal 24 by 5.6 million. That's mainly due to negative currency effects and the creation of bad debt provisions that was resulting from a reassessment of polysilicon customers in China. While last year's positive result was mainly driven by the contrary, there we had a recovery of already written off accounts receivables and some real estate income. Total EBIT increased substantially by 23.2% to 140.8 million, yielding an EBIT margin of 12.9%. With overall financial expenses at prior year level, also including our new bond or the increased bond, a tax rate of 23%, slightly below the last year, total net income ended the fiscal year at 105.6 million, crossing the 100 million mark for the first time. How does this result break down into the divisions, starting with systems? Following a peak in 2022, the global systems market further normalized in 2024, with a decrease predominantly driven by policy shifts in the HME segment. Despite this, the systems division, the leading position the system division has in growing subsegments like the LPG marine business, hypercompressors for EVA, low-density polyethylene, and the LNG market resulted in a strong order intake of 825.4 million. That's a 5.8 million growth, respectively 6.9 million net of foreign exchange currency effects. On the back of the high order intake from the past 2 to 3 years, sales increased by 18.2%, net of FX effects 19.5% to almost 750 million. Further optimization measures in the field of production logistics and cooperation with strategic suppliers enabled the timely delivery of a very high number of projects in 2024. Gross profit increased by 41.1% year over year, 142.8 million, yielding a gross margin of 19%. That's 3 percentage points above the prior year, mainly due to the more favorable product mix, as well as the before mentioned high production capacity utilization in all the manufacturing sites. The high gross margin and the further operational leverage on SG&A expenses have led to an EBIT increase in the systems division of 67.8% to 68 million Swiss francs, generating an EBIT margin of 9.1%, which is 2.7 percentage points above the last year. Moving over to the services division, the services market, they have been strongly influenced by different local economic conditions. Order intake overall fell by 5.4%, net of FX effects, that's a reduction of 4.5% to 326 million. The main reason for this decrease was the closure of 3 service centers in the US, where we focus on higher margin locations within the country, and also the decrease in European markets, especially in Germany, due to economic and political uncertainty in the course of 24. On the positive side, Asia Pacific, the Middle East, Central Asia, Eastern Europe, they grew at a good pace, but could not compensate for the drop in the US and in Europe. Worth to be mentioned is the further increasing service presence also in the marine market, thanks to the growing installed base on the one hand and our strong worldwide service network that we have in place for services. At 347 million, sales were 2.2% above the prior year's figure, or 3.1% net of FX effects. This rather moderate growth has been affected by the same factors that I just mentioned on the order intake level. Gross profit increased over proportionally by 6.3% to 163.5 million, resulting in a gross margin of 47.1%, which is 1.8 percentage points above the prior year. The higher gross margin is resulting from the higher share of spare parts in the sales mix and the before mentioned closure of US facilities where we reduced the volume of low margin business. This significantly higher gross profit reduced by one-off expenses related to the closure of the service centers and the negative FX impacts resulted then still in an overall EBIT increase in services of 2.6% year-over-year to 85.7 million. And that's an EBIT margin of 24.7%, 10 base points above the prior year. On this slide, I would like to guide you briefly through the summarized cash flow statement. Cash flow from operating activities was significantly above the prior year, mainly driven by the higher net income on the one hand, as well as the favorable development in the net working capital as per the balance sheet closing date. We will have a closer look at that when we look at the balance sheet. Cash flow from investing activities amounted to minus 17 million, consisting of CapEx investments in the amount of 25.4 million. That's more or less at an eye level with depreciation, mainly in maintenance and debottlenecking CapEx, but we did not have to invest into growth CapEx to achieve these sales that we have seen. What is also included here is cash in the amount of about 8 million from the sale of property and equipment in the context with the closure of the service centers, trucks, real estate, that is shown under this position. Then the cash flow from financing activities is including the outflow for the payment of the dividend last year, in the amount of 52.5 million, which is 12 million more than in the year before. And furthermore, we have also repaid bank loans amounting to about 66 million. And on the other hand, we increased our bond by 50 million to 150 million, again with a 4 years term at a very similar coupon interest rate like the one that we had before. Then currency translation effects, they were mainly related to cash positions in subsidiaries outside Switzerland, and the borrowing slightly decreased by 17 million compared to the last year, and is mainly consisting of the bond amount in total of this 150 million. With this, the overall net financial position turned positive to close to 70 million Swiss francs, a strong swing from last year's net debt of minus 62 million. Then on the balance sheet, we continue to demonstrate a robust balance. Equity, property, plant and equipment remained at the same level as in the last year. As I mentioned, we did not have to spend any substantial growth. CapEx were to be mentioned. Inventories decreased by about 4% to 302 million. And the balance between advance payments that we get from customers on large projects, work in progress, and advance payments to suppliers remained positive and further increased by 54 million Swiss francs as per the closure date. Then, despite the sales growth of 12.6%, trade receivables ended the fiscal year slightly below last year at 356 million. What has to be mentioned, however, is that the amount or the percentage of overdue positions more than 90 days has increased to 24% of the total accounts receivables, and that was at the level of 12% the year before. This increase is mainly related to projects not only in China, but also in India, where we had some large projects, and in the US, measures have been taken, and as we speak, in the meantime, we have received substantial amounts on those positions. But that's the snapshot per closing date. Then total shareholder equity rose by 44 million to 340 million. With this, the equity ratio went up to 29.1%. That's 120 base points above the prior year, despite the higher dividends that we paid in 2024 and negative FX effects that is also reflected on this position. Now, I would like to give you an update on RONOA and value creation slide that we shared already in the last year's presentation. Our RONOA further increased to 32.6% in 2024, resulting from the combination of a higher EBIT margin and a higher asset productivity. As you can see from the graph on this slide here, the profitability at level EBIT margin has continuously improved over the past 6 years, up from 7.4% in fiscal year 2018 to 12.9% in the fiscal year that we just closed. So within the same time span, our asset productivity, or in other words, sales over net operating assets, has doubled, and the RONOA increased by more than 20 percentage points with that. Now, if you compare us with the peers, which are indicated with those dots here on the slide, you will see that some of them have indeed a higher EBIT margin, but none of them has the same asset productivity, at least those that have published figures to compare with. And this has also a reason. The high asset productivity is also linked to our business model. In a systems project, you have about 50% or sometimes even less, only consisting of the compressor. The rest is auxiliaries like electric drive, coolers, dampeners, etc. So we can leverage the asset base of our suppliers. We don't need manufacturing capacity or manpower to produce this roughly 50% of a project value. Then earnings per share, they have continuously grown since fiscal year 2018 as well, with a CAGR of 25.1% up to 31.20 francs per share, based on the strong result. And Fabrice mentioned that the board will propose a dividend of 18 francs per share to the AGM for approval within the guidance of 50 to 70%. Worth to be mentioned is also that Burckhardt Compression has paid to its shareholders every single year since the IPO without interruption dividend. And as you may have seen or realized, Burckhardt Compression continues also in 2024 to be listed in the SPI Select Dividend 20 Index. Then last but not least, on this slide, we would like to share with you the capital allocation strategy, or reaffirm what we have already presented during the capital market day in 2022, our disciplined approach in allocating capital. On the one hand, we support organic growth with maintenance capex. Some dedicated capex will also be necessary for investments in the context with the MRP initiatives, but all under RONOA greater WACC conditions. Then on the M&A side, we focus on bolt-on acquisitions with a focus on the services division. That does not mean that we would not look into other opportunities as well. And on the shareholder return, we are committed to redistribute part of the profit within this bandwidth of 50 to 70%. And also we are aiming as a kind of an ambition level to have an equity ratio of 30% plus. With this, I would like to thank you for your attention and hand back to Fabrice.
Thank you, Rolf. Now let's go to the part which I'm sure you're interested in as well, or especially our outlook. And I will start first with the potential impact on US tariffs. Then I will look beyond into the megatrends that support our business and end up in the middle with the outlook for the fiscal year 2025. US tariffs. They present a clear short-term challenge, but mostly indirectly through the impact they can have on the economy and on some of our customers. And looking on the left of the slide, the impact is in three areas. First, the direct impact. We expect it to be neutral to slightly negative. We actually don't see any impact on our backlog for projects, for instance, that we have in the US. We also see a limited impact on future projects because none of our direct competitor has a factory in the US. So it means that the customers will have to pay the tariffs and will have to pay more for the compressors, basically. Now, where there could be a limited impact, it's on our spare parts export from Switzerland to the US, which are now hit by the steel tariffs or the other tariffs. Depends, we never know. It changes every day. And that is, however, a small part of our business, and that we can localize step by step. Because the main parts of a compressor, a customer has no choice. Nobody can build these spare parts. What he can do is on the simple spare parts. Then he can try to find some alternative suppliers. But again, this is very a small part of the business. And today, customers are paying the additional 30% or 50% without challenging that too much. They can't change quickly. And again, we can localize step by step if they start to do it. Regarding the macro environment, the lower GDP growth could lead to slower demand in certain regions, and also the Swiss franc, we have to mention, that could also, of course, affect our competitiveness with our Swiss factory. Finally, going to the BC market, we expect some various response from the different market. If I look at the hydrogen market, clearly the IRA in the US is negative impact on this market. If I look at the oil price going down, that's also not positive because that makes hydrogen more expensive in relative terms. If I look at the PCI market, a slowdown of GDP growth will also potentially slow down the demand for polymers and therefore the demand for additional capacity in terms of polymer production. On the other side, there can also be some positive aspects. I mentioned before, Middle East. Middle East has a lot of energy, cheap gas, and from a geopolitical perspective, it's a neutral place. So we see investments now going into the Middle East. Also China. China today is still very dependent on petrochemicals import from the US. So they continue to build capacity in order to be less dependent. So that's the segment by segment approach. Now, on a concrete project by project basis, we can see some potential delays on decisions from some customers on large projects, for new projects, not the ones which have already started. The ones running where they don't have yet ordered the compressors, then they will continue. New ones may have a small delay for decisions. On the service side as well, larger projects like upgrades of compressors, maybe customers take a bit more time to decide if they do it now or if they wait another few months to see how the situation with tariff is. That said, and that's the rest of the slide, it's important to highlight that we have quite some stability in our setup. First, we have this very large order backlog, which we have even increased in 2024. We have a diversified business model, a global market presence. We also have a resilient service business. Even with zero growth, the compressors continue to run. And as they run every day, they need spare parts, they need maintenance. So that provides some stability here. And finally, we have a global footprint with local value added. And we can play with that to avoid tariffs or to go around with the tariffs very clearly. Nevertheless, we don't just rely on that. We have some actions in place to mitigate the potential impact of these tariffs. And as I said before, it consists in basically accelerating some of the things that we were already doing. Accelerating operational excellence, MRP initiatives, accelerating local value added, for instance, in China with the spare parts, in India, I mentioned it before, and also further diversifying our offering, launching new services. With this, we can mitigate and provide some positive dynamic into our competitiveness and into our orders. So that's let's say the short term, and we watch this very carefully. And in our outlook, we have considered all these plus and minus as we know them today. We will update you during the half-year call. There might be a number of new things until then. Now, if we look further ahead, beyond the short term, our business is supported by 3 megatrends. And our strategy is well in place to capture the benefits from that. First, the growing global population, especially the middle class, create needs for more polymers, more cars, more furniture, meaning more polymers, more transportation, meaning more energy. And all these more fertilizers for food, etc. And all these applications require compressors. Also, a new aspect, artificial intelligence requires a lot of additional energy. Looking at the US, there's a planning that the electricity demand in the US could double between now and 2035 just because of AI. That means more energy, which depending on maybe on US states, might be with renewable energy or with natural gas, but clearly need for more energy due to global population. And not only there is a need for more energy, but it needs to be more secure. One reason is geopolitics, and we see that in Europe, for instance, with all the new LNG import terminals which are created, and then they generate a need for LNG tankers, which create a demand for compressors. Another reason is the challenge related to intermittent renewable electricities like solar or wind. that creates a need for energy storage, which can be also done with molecules, with natural gas or with green molecules. And finally, even moving to the right, even if some countries are moving backwards nowadays, the world continues its transition towards renewable energies, especially, of course, in Europe and also in China. China is moving very fast here. And the first effect is the increase of natural gas in the global energy mix. If you look at 2024, 40% of the additional energy demand has been covered with natural gas. So much more than oil, coal, nuclear, hydro, and all the rest. So natural gas is the fast-growing energy source, meaning more compressors. And also, of course, the energy transition requires new infrastructure investment into this renewable solar panels. So again, hypercompressors, hydrogen, green ammonia, meaning tankers, etc., etc. So overall, for all these reasons, independently of what happens in the short term, the world will need more compressors. And the strategy that we have is basically the continuation of the strategy that we presented at the Capital Markets Day. It is in place today. So now, in the context of these megatrends and the US tariffs, let's move to the outlook for 2025. To wrap up the previous slides, we are clearly in a dynamic operating environment with some uncertainties. However, we have a resilient setup and we have mitigation actions in place. So given all this, we expect sales for fiscal year 2025 at a similar level at 2024, meaning around 1.1 billion for the group, with an EBIT margin also at a similar level as 2024. In terms of balance within the year, we expect a stronger profitability in the second part of the year due to the product mix and the service mix as well. So basically, with this guidance, we plan to repeat the record year 2024 in a context with a higher Swiss franc. And with that, we also remain fully on track to reach our 2027 MRP guidance, which is 1.2 billion sales with an EBIT margin between 12 and 15%. With this, it closes our presentation.